the advanced series. This is the Price Action Junkie, and in this presentation, I'm going to be demonstrating how you guys can apply an objective analysis in determining your long-term bias. And we're going to be specifically talking about using quantitative analysis in determining your long-term bias. Now, I know you guys are familiar with technical analysis and well, at least the basic concepts of technical analysis and the concepts of fundamental analysis. And there are more specific ways that we can analyze the market that can help us come to a more educated guess per se, right? Using the circumstances and factors and resources that we have. And that is going to be either quantitative analysis, right? And then you have something as well as called qualitative analysis. But in this presentation, we're going to be specifically talking about quantitative analysis. So what is a quantitative analysis? It is the use of measured statistical models, data, and research to comprehend behavior. So what are specific type of examples of quantitative data that we're going to analyze today in this presentation? In regards to the foreign exchange market, is going to be the commitment of traders chart and report and a global interest rate differential. What is a commitment of traders report? A commitment of traders report is a public report that's generated by the CFTC on a weekly basis as to provide a take on market sentiment. And there are certain requirements that must be measured before this data can be published. So in order for them to be able to actually report this information to the public, there are a couple things that have to be met first. One, there has to be 20 or more traders with positions at or above reporting levels that are required by the CFTC large trader report. And those reporting positions are transactions in securities of 2 million shares or $20 million in a week, or 20 million shares or $200 million in a calendar month. Now, this is not too important necessarily to know so deeply or as to much in regards to where the commitment to traders report comes out, what exactly are the the criteria and the details of it down to a T. But it's just good to have a fundamental conceptualization of it, so that way when we actually apply it later on, it'll make sense. So the commitment to traders report is a report that of the CFTC, right? So we know that this is coming from the government. This is a public record. This is public information that they report on a weekly basis, and specifically it comes out every Tuesday when they see more than 20 traders have positions in the market, meaning they have placed orders or transactions exceeding 2 million shares or $20 million within a week, or 20 million shares to $200 million within a month. All right. But again, we will only be referencing the commitment of traders chart. Right. So we'll see it in the graph form, and I'll be able to narrate it for you. And we're not going to be too caught up on the report, but I will show you guys a picture screenshot, right, of what a commitment of traders report might typically look like. So you see you have in red to the far left, you have the open interest, right? The total open interest. Then you see the large traders in green, right? The non-commercials. And you see how many positions they have, right? Long or short. Then next to them, you see the commercials. You see how many positions they have open, long, and short, right? And then off to the side, you have some non-reportable positions. So we're not too worried about that. But I just want to give you guys an introduction to the commitment of traders report if you have not been, if you're not familiar with it. Now, when we talk about the commitment of traders chart, there are just going to be some key aspects to it that we're just going to need to know, because it's actually very, very simple to read and comprehend. So one thing we need to know is that there are going to be two factors, right, that we're going to focus on. And that's going to be the commercials and the large speculators, right? The commercials are going to be notated in red, right? And the commercials represent the central banks and the interbanks, right? And the large speculators will be notated in green, right, represent large funded traders like hedge funds. All right. And we're going to be referencing this chart using the terminology of net long and net short. So just remember those phrases: net long and net short, right? That's above the zero line, right? Meaning that there are more long positions that are placed in short. And net short is below the zero line, meaning there are more short positions that are placed than long. And don't be too confused right now, guys, because for my visual learners, we're going to plot this out coming right up, right next. So I'm going to actually show you all this, a commitment to trader chart, and then how you can actually apply it in determining your bias in the currency exchange market. All right, so we're going to take into consideration the commitment to trader chart. And then we're going to tie it together with the global interest rate, which is the interest rate set for the main economies that are set by their central banks. Now, when we look at the global interest rates, we're going to have to take into consideration the current and previous interest rate, the last change date, meaning the last date that the interest rate was changed at the central bank level, the direction, right? What direction did it go up or down in the change? And then you'll be able to determine the interest rate differential, which is important. And incorporating additional factors can be used in determining long-term order flow. All right, guys, so I want to give you a foundational conceptualization of using a specific type of quantitative or measurable objective analysis. We're going to reference globalrates.com and barchart.com. And you can set up free accounts with both of these references. And now we're going to get into the charts so we can actually apply this information. All right, guys, here we go. So the first place that we're going to visit is global-rates.com. And you should be brought up to a page like this. Now, what we're going to be looking for here is for the central banks table here in the middle, because we're going to be looking for the interest rates of these currencies. Right now, we're not worried about inflation or these other statistics. We want to focus on the interest rate. So here, click on more information on central banks. And what's going to populate is the list of central banks around the world that's in their database and the current interest rate set by these central banks for the currencies of the country. So this is the current interest rate of the American dollar, right? Because this is the American interest rate, the Fed, the Federal Reserve. This is the current interest rate of the Australian Reserve Bank. This is the current interest rate of the Chile Reserve Bank. Now, I don't want you guys to get too caught up on trying to necessarily know or memorize all of these countries' interest rates. You want to, again, only focus on what you're focusing on. So if you're only trading one pair, then you only need to know the interest rate of the currencies of that pair. If you have, your 2-3 set pairs, then you only need to maybe take into consideration the interest rates of just those few pairs instead of having to worry about the interest rate of all these other countries. It's honestly superfluous. All right. So as you can see, you have the central banks here denoted on the left and the country that they represent. You'll see the current interest rate of that currency. And as you get over here, you begin to see the direction, right? And this direction is in correlation to the last change, the last date that the interest rate was changed. So we see here for the American interest rate, right, the Federal Reserve here in the United States, the last time the interest rate was changed was of March 2020. And we all know that was right in the middle of everything. You feel me? In the beginning of it. And the previous rate before they changed it, March 15, 2020, was 1.25%. After that rate of change, the interest rate dropped, and now we've been at a current interest rate of 0.25%. So we dropped a whole rate of interest. Essentially, you dropped the whole point. We dropped a whole number. You feel me? So what's going to be important to take away from this is because when we're trading currencies, we're trading two currencies against each other. So if you're trading the United States dollar versus the Canadian dollar or USD CAD, or if you're trading the Great British Pound versus the Japanese yen or GBP JPY, you're going to have to take into consideration when you're making these objective observations and this qualitative analysis, right? This measurable analysis, you have to take into consideration both those countries' interest rate. And what you're going to get from that is an interest rate differential. So for instance, let's say we're trading the American dollar versus the Canadian dollar, right? So we'll find the Canadian interest rate, right? Or the Bank of Canada here. And their current interest rate is a 0.25. And we look up here, the American Fed interest rate is a 0.25 as well. So we take the differential of those countries' interest rate, we'll get a 0. So we'll actually look and see how this is depicted and if this is going to follow suit and be true when we actually look at it on the graph, looking at the real commercial positions, looking at the real positions of the banks in real time. Let's see another example. Looking at the interest rate list in front of us, if you wanted to find GBP JPY, right? If we're trading GBP JPY, and maybe want to see long-term what the direction of the market has been and what it possibly can be going, right? So we'll find the Bank of England interest rate, right, for Great Britain, and their current interest rate is a 0.25%. Then we'll have to scroll over here, find the Japanese interest rate or the Bank of Japan, and their current interest rate is a negative 0.1%. So taking an interest rate differential of the Bank of England, which is 0.25%, and the interest rate of the Bank of Japan at negative 0.1%, the differential will be 0.15% in favor of the Bank of England. So with that being said, we can take that and we can reasonably come to an updated bias, right? That long-term GBP JPY should be bullish or should have been bullish. And we'll be able to actually map this on a commitment of traders chart and actually see if it's played out looking at the commercial bank's position in real time. All right. So now you want to go to barchart.com. All right. And I want you guys to follow me here. This exercise has to be done. This analysis has to be done looking at a futures chart. So you're going to click futures, scroll up down here to the left and the bottom second, the second to last second here on the left, and under commodity grouping, select currencies. So now the first example that we did was the United States dollar versus the Canadian dollar. And what did we determine? That the United States Fed rate is currently at 0.25%, and the Bank of Canada's current rate is at 0.25%. So they're at a stalemate. So it would be reasonable to conclude or come to an updated bias that maybe long-term, the market hasn't had too much of a trend because they're even. So now let's take a look at the position of the commercials in real time. So we're here on barchart.com. We select the futures, we select the currencies, and now we're here. So now we're going to find the futures contract, and we want to find the most up-to-date futures contract. So now we're in 2022 as of today, January 11th. And the next up-and-coming one is March 2022. Now, you don't want to just go solely on the next contract. You also want to scroll over here and find the one that has the highest volume. So we see for the United States dollar, we have the March and we have the June futures contracts. But we scroll over here to the volume, the March contract has the most volume. So this is the one that we want to look at. So we're going to select the US dollar. And then we're going to scroll over here, and under charts, we're going to select interactive chart. All right. So you have a chart pull up, and it should already be here for me. But over here, you would select study. Here, I want to show you guys here. You would find where it says US dollar index, March 22 contract. You would want to find this button and select plus study. And then you will go here. I'm going to take that off. And then you would type, right, commitment of traders. You're looking for the commitment of trader chart. And then these settings are going to pop up, and you're going to make sure you select small speculators off, right? Want to make sure that you select small speculators off so that only commercial speculators and large speculators are populated. And for the sake of this demonstration, commercial speculators will be notated in red and large speculators will be notated in green. And it's important to know that it is the large speculators or large fund traders who are the opposing, who are in opposition, or the opposing traders to commercial banks, right? To the central and interbanks. That is their opposition in a sense. All right. So this is why, because small speculators, we don't have, this is like this is the dumb money in the markets. They don't really have any clue in what's really going on. This is the majority of people that are trading, majority of people that are losing money. So we're not concerned about small speculators. We only want to look at commercial speculators and large speculators. All right. So now looking at the commitment of trader chart, I'm zooming out a little bit just so we can see it all together here. Okay. So down here is where we have a crude depiction of where the positions of the large funded traders who are in green and the commercial, the central and interbanks who are notated here in red. All right. And here in the middle, you have the zero basis line. All right. So what this means is that when either large funded or commercial are above the zero basis line, this is a representation of net long positions. And by net long positions, we mean that they have more long positions than they do short positions. And when you see them under the zero basis line, this is an indication of net short positions that they have in the market. So ideally, you can reasonably conclude that, okay, well, if we know that the commercials have the most influence in the market, then we should see price action in alignment with what is depicted here on the commitment of traders graph. And what we see is that over time, the US dollar has been consolidating up until around here. This is around that March time when the interest rate changed for the United States dollar, right? And where do we see the commercials? We see the commercials here under the zero basis line. Well, under the zero basis line, I would say, right? So this means that they are net short in the market, right? So maybe somebody who's new to this will say, okay, well, if you're telling me that the commercials have the influence over the market and the commercials here are supposed to be net short on the US dollar, then shouldn't the US dollar be declining here? Well, let me explain to you what's going on. The commercials here are net short, right? Meaning they have more short positions here in the market. So what we see price action doing, and how price action is telling us what's really going on and how the commercials are building up short positions, is we have consolidation here, right? And in regular basic retail conceptualization, they tell us that, hey, don't trade consolidating markets, wait for the breakout. But what a consolidating market is smart money accumulating positions. So when we see here that the commitment of traders is showing us that commercials are net short, but we see a consolidating market, that means that they are accumulating short positions. And then what do we see happen here? Shortly after 2020, right? We seen the market reprice lower. And as the market repriced lower, we saw in the commitment of traders that the commercials began to cross over the zero basis line. Not by much, just barely cross over the zero basis line. As market repriced lower because they had a buildup of short positions. So now because they were wanting to sell, right? They're gonna want to sell out into long positions. So we see now that the commercials have crossed over into the zero basis line, just above the zero basis line, as they're getting out of accumulating their long positions. So as they're getting out of their short positions, right? So they were selling, manipulated the price up here, sell out of those short positions. And we've seen that now they're starting to cross up and over the zero basis line as the market reprices lower. And as they hover over the zero basis line, now we see this consolidation right here on the US dollar. And again, they moved higher over the zero basis line, right? Which would theoretically, we would say, hey, they should be net long here, right? The market should be bullish here. But why is it repricing lower? Well, the market is repricing lower because they're making a run on sell side liquidity. And we see this positions here on the commitment of trader chart. This means that they're hedging out of these short positions. So they're accumulating net long positions, but we see that the algorithm is repricing lower, then the commercials are hedging out of their short positions. So now they're accumulating long positions. And what happens? We've seen price reprice higher until what happens? On the commitment of traders, we see that the commercials cross below the zero basis line, and then price began to reprice lower once again. And now we see a depiction where the algorithm has repriced above these highs, running buy side liquidity. But what do we see the commercials have been doing? The commercials have been more net short than they have been in a long time. We're talking about 2 years. There have been more net short on the US dollar than they have in a long time. And as we see the algorithm reprice higher on the US dollar, but commercials are actually net short, they are hedging out of these long positions. So it's reasonable to assume that in sometime in the future, we will see a decrease in the dollar's price. And I don't know how familiar you guys are with what's going on with the way inflation is going, and a persistence of what's going on with this virus. That's kind of in alignment. So now that we looked at the US dollar, we want to go take a look at the Canadian dollar. So we want to go back here. Let's go back to currencies. And now let's find the Canadian dollars futures contract. So we see we have the Canadian dollars futures contract. Okay, we see we have March and June futures contracts for the Canadian dollar, but we want to find the ones that have the most volume. So we see here the March contract has 54,000. So we want to select the Canadian dollar March 22 futures contract. All right. So now which one are we going to select here? The March 2022. All right. Remember, go over here to the left, interactive charts. And because we selected it already, we should not have to go back to study. The commitment of traders chart should populate here as it has. So you see, we're here looking at the Canadian dollars March 2022 futures contract. And again, just to remind you, the interest rate differential for the United States dollar versus the Canadian dollar is 0. So this is USD CAD, right? So this would be USD CAD. So we would expect to see maybe a consolidating market when we look at USD CAD. But here we're going to look at measurable data, right? This is why we're looking at the actual interest rates of the currencies. This is why we're actually looking at the real-time positions using the commitment of traders chart of the commercials. These are the central banks, the interbanks, right? And they're traders denoted here in red. So here on the Canadian dollar futures contract, right? We've seen that recently pretty much, right? Since around March 2020, the Canadian dollar has been bullish. It's been, more so, some people would say more so this will be bearish, right? But I'm going to say, because we're looking at a 3-year time frame here, right? 3-year chart. It's pretty bullish. So now let's take a look at the commitment of traders report, and let's read it, and let's see what it's actually telling us. So here we have the commercials in red in direct opposition to the large funded traders or the large speculators, right? We see that the commercials are well above the 0 basis line, meaning that they are net long, and this is the most they've been net long, right, up until this point. And what do we see the market do? We see the market actually consolidate. We see the market consolidate here. And then we see a slight repricing higher as commercials dip below the 0 basis line, selling out of their long positions here, right? I want to be able to tie this all together for you guys. So they were accumulating here in this consolidation. What they tell you not to trade, but if you know, you know. They were accumulating long positions here. We know that because they're above the 0 basis line, meaning that they're net long. And what did they do? The algorithm repriced higher. So they had to sell out of their long positions, right? And who are they going to sell out of their long positions? They're going to sell to willing buyers in the form of buy stops above these highs. And do we see a clear depiction of it here? Yes, we do. Because as the market repriced higher, the commercials dipped below the 0 basis line and they began having more net short positions than they do long positions. And then we see it kind of teeter around here, around the 0 basis line. And just notice, guys, how the large funded traders, the large speculators are in direct opposition to the commercials. They're diametrically opposed. They just have more of an idea than the small speculators do, right? So as we continue along the timeline, so we see the teetering around the 0 basis line. Then they had the most net short positions they had in a while here. And what do we see price action telling us? Here we actually see a highest form. So we know that means that they were hedging the market here. They were hedging the market. And this is consolidation. But what do we see actually happening? We actually see an accumulation of these shorts here that they had when they had the most amount of net short positions in a while. And they're accumulating these short positions here, selling here at the highs. And then what do we see price action do? We see price action take off. We see price action melt. We see price action melt. and now they had to buy out of their short positions. And we see that here on the commitment trader chart as the commercials move over the 0 basis line. So what this does is it really brings the story into full effect. It brings it full circle. All right. Being able to see an actual depiction, right, of the positions of the commercials in real time. And then knowing what you know about runs on liquidity and what the market is doing and why it is moving the way it is moving, you begin to piece it together and it'll begin to make sense. So that's why it's important to be able to have subjective biases as well, but it's always great to be able to refer back to stamped, verified, factual information, such as a commitment to trades report, or knowing the actual interest rate differential of the currency that you're trading. So that was an example for USD CAD. Now we want to actually look at a depiction of the charts in real time and see if that's what we have for USD CAD. So knowing that the interest rate differential was 0 for USD CAD, looking at a weekly chart from a range of about 7 years from March 2015, excuse me, this is from about December 2014 to present day, January 11, 2022, we see that the market has in fact been moving more so sideways. Now, there are also some pretty decent moves here. Remember that we are on a weekly, but looking at a higher time frame, right? Because this is what the commercials are trading off of. This is what the institutions are trading off of. They're not really too much scalpers or intraday traders. They're going to be more short-term swing, long-term positional traders. So this is why I got to be able to pan out and be able to look at the market from a higher perspective to really see what's going on. And we can see that there's a correlation here between the qualitative information that we just observed, right? The objective information that we just observed, and that there is no difference in the differential in the interest rate between the United States dollar and the Canadian dollar. So we would conceptualize and reasonably assume that the market would be consolidating. And we see that here for USD CAD. All right, I'm going to give you guys another example here with the Great British Pound and Japanese yen, right? GBP JPY. And so we're going to find the Bank of England here, which is a 0.25 in current interest rate, and the Bank of Japan, which is a negative 0.1 interest rate, giving us an interest rate differential of 0.15 in the favor of the Great British Pound. So knowing that GBP JPY, right, and the interest rate differential is in favor of the pound, we can reasonably conclude that long-term GBP JPY should be bullish or have a bullish order flow or have it. So let's look at a commitment to trades report first before we refer to TradingView. Back to currencies. Now let's find the British pound. Here we have March and June. March 2022 has the most volume, so we're going to select that. March 2022. Now we're going to scroll over here to the left, interactive chart. And here we have the British pound March 2022 futures contract. So we already know in the back of our head that the interest rate differential is 0.15 in the favor of the pound. So we would expect we can expect that in regards to GBP JPY, that pair should have a bullish order flow, or should have a relatively bullish order flow up until now, based on the interest rate differential. And it's really important to grasp the concept of this interest rate, because that is what price is chasing. You got to realize, what is interest rate, right? Money that is earned on top of your money. So you got to realize they're going to be chasing the highest yields on interest. So if the Great British Pound has a higher interest than the Japanese yen, then they're going to be trying to reprice the market higher in order to get the most return, or the highest return on their yield. All right. Just to kind of make it make sense for you guys, this is why knowing the interest rate is so important. You don't necessarily, like, it's good to know about fundamental analysis and knowing news reports and things like that. And there's certain reports that come out that have an impact on, what happens on a short-term basis in the market, such as FOMC or NFP week, right? Or certain consumer growth information and reports. But even those numbers and things can fluctuate so much, right? Interest rate stuff, but that usually doesn't change like that. But you have real concrete and solid information right here, using like a commitment of traders report showing you a depiction of real-time position of the commercials, and looking at global-rates.com and the actual statistics that's on there, such as inflation rates, or looking at just interest rates, right? So here we are looking at the British Pound March 2022 futures contract, right? And looking at the chart, we seen that price coming in here around February 2019, that the market consolidated and then ultimately repriced lower, going into around August 2019. So what is the commitment of traders report telling us? The commitment of traders is telling us here that the commercials were net long here. They were net long here, so they were above the 0 basis line. But we see that the market here is consolidating. So what do we know is true consolidation? What that really means is that there's accumulation going on in the markets. And we can look at the commitment of traders report, and it would be reasonable to assume that there is an accumulation of long positions coming here by the commercials. But what do we see happen? We see the commercials actually then dip down into the 0 basis line. And then as this happens, right, we begin to see the algorithm reprice the pound lower as the commercials began to gain more net long positions than they had in a while. So in this entire time, even in this move to the downside, this is a false rally down. This is a fake out move. This is a move to engineer liquidity into the market. The algorithm repriced the market down, and the commercials, knowing, right, the smart money, knowing what's going on, they began to build more net long positions than they had in a while, up until this point here, around August, right? Around August 2019. Then we began to see the algorithm reprice the market higher, right? Reprice the market higher here, ran these highs, activated buy stops here, and then the commercials began to get out of their long positions. They began to get out of their long positions here. So they began to sell out of their long positions. And now they're going net short. So they're selling out of these long positions here, right? They were long here, so they're going to have to sell to who? They sold to the willing buy stops that they just tapped into. And now they just took those buy stops out because they went net short, and then the market tanked here, around March 2020. And we see that the commercials were net short during this time as well too. And then they began to go net long again because they crossed over the zero basis line. And we see that the market came out of this dip and began to reprice higher as well. And now the commercials are kind of teetering here around the zero basis line as the algorithm is repricing the market higher. And as the market is continuing to reprice higher, running these equal highs here, we see that the commercials have begun to become net short here. So they became net short here around May 2021, right, of last year, early of last year. They began to go net short here where the market was at a high relatively recently, right, over the past couple of years. The market was at a new yearly high, right? Commercials were net short. And what do we see happen? We see the market begin to reprice lower, and then commercials fall out of their short positions. Algorithm repricing higher now as the commercials are more net long than they have been in a while, meaning they have the most net long positions than they had in a while. And we know that the Great British Pound has a stronger interest rate differential than the Japanese yen, right? So we began again to put two and two together because everything so far has been in alignment with what the commitment of traders graph has been showing us, along with what price action has been showing us here. All right. So this is the British pound. I'm going to show you guys the Japanese yen commitment of traders chart. And then we're going to see if relatively the Great British pound has been making, or not the Great British pound has been making, excuse me, but we're going to see relatively if GBP/JPY has had a bullish order flow based on the information that we've observed here. So now we find the Japanese yen, March, June. The March has the most contracts. Interactive chart. All right, so now we're looking at the Japanese yen March 2022 futures chart. And we see the commitment of traders report here, right? Because we see that we know that the Japanese yen has a -1 interest rate. And their interest rate was actually changed on February 2016. The last time the England's interest rate change was actually December, just a couple of weeks ago, actually. A couple of weeks ago, it went up 0.1%. Japan hasn't had a change in their interest rates since 2016, and when they did, they dropped. They were at 0, then they dropped to -1%. So it would be reasonable to assume that the Japanese yen should have been bearish. And what do we see here? We see that relatively Japanese yen has been bearish. And where do we see the commercials at here? During this play on price action, we see the commercials are net short here. They're more net short than they have been in any other time, right? They're more net short than they have been in any other time, right? And what do we see happen? We see the algorithm reprice lower. We see the commercials buy out of their short positions. They cross the zero basis line. And we see that they're now net long. We've seen price reprice higher a little bit, right? And we see that now they've been net long here as the algorithm is repricing lower. And what does this mean? Because we know that the algorithm is repricing lower because there's sell side liquidity here. There are equal lows here. So this is a pool of sell side liquidity. So we know that the central banks went short here, right? Because they had the most net short position they had in a while, right? So they went short here. And how do you get out of a short? You have to buy out of it. So they're going to catch the market at a very deep discounted rate. And then they're going to get all of these long positions filled. So it'll be reasonable to conclude, right, based on that analysis, that we could maybe see any upcoming future a repricing higher, right, of the Japanese yen. So maybe in the Japanese yen market. Okay. So now seeing that the commitment of traders chart, right, looking at the futures chart and then correlating it to the interest rate differential, it has been in alignment. Japan has had a -1 interest rate for the past 7 years, 6 years, something like that. And we've seen that they have been bearish right here on the 3-year chart. And we know that the Bank of England just recently changed their interest rate and they went up, but they have still been overall bullish. And we know that the interest rate differential is in favor of the Great British Pound. So now we're going to actually look at a trading view chart and we're going to see what the market looks like. All right, so what do we see here? Now we see the British Pound versus Japanese yen. All right, this is on a weekly chart, so on a weekly time frame. All right, so we see that since June, around June 2016, right? Around June 2016, we start to see that this market has consolidated, right? So now you say, okay, well, but Great British has the 0.15 interest rate differential in their favor, right? Okay, now let's be good students, right? And let's be critical thinkers. Again, this is why it's important to take into account all the information you have before us. Because if we look at the Bank of Japan down here, the last time their interest rate was changed was in 2016, early 2016, right? And that was in February. And then we've seen that as well, the market was dropping before then, right? But we're not gonna get too far ahead of ourselves, right? So we've seen the last time the Bank of Japan interest rate was changed was 2016. We've seen the last time that the Bank of English interest rate was changed was just a couple weeks ago, literally a couple weeks ago, right? Before they were 0.25%, they were 0.1%. Before Japan's interest rate changed, right, they were 0% before they got changed in 2016. So they've been -1%, right, for the past few years, right? And up until a couple weeks ago, the Bank of England was at a 0.1%. So they were not too far off, right? -1, right? And 1, that's going to give you what? 0, guys. So it makes sense that we saw a consolidation for a while, right? And then taking into account the strength that the Great British Pound gained, right? We are here in 2021 and 2022, that the British Pound Japanese yen began to reprice higher as the yen continued to have a negative interest rate and the pound's interest rate continued to gain in price. So guys, this is a depiction of how you can actually put together a commitment of traders graph and then using the interest rate differential of whatever currency pairs you're trading.